Hi, everyone. Thanks for being here today. Welcome to Put More Jingle in Your Pocket. I am excited to be here. I am the Director of Family Childcare Strategy and Advancement at WICA, the Wisconsin Early Childhood Association. And I would like to thank Paola for being here, doing our interpretation, and I want to thank Satellite for hosting me. We have a disclaimer to start, because of course we do. The information contained here has been prepared by WICA. The WICA team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee completeness or accuracy, and it is not intended to constitute legal, tax, or financial advice. And reproduction of this information is prohibited. This is for educational purposes only and is not individual tax advice. So let's start by celebrating. Welcome to 2026. I found this quote from Oprah Winfrey, and I thought it was a perfect way to think about our taxes. Often people have certain feelings around their taxes, and they may feel overwhelmed. They might not feel they're getting it correct. They may be like, man, I have so much paperwork to do. Next year, I'm going to do it differently. And so part of why we timed this session to be in early January is to help be that boost, to help you think about managing your tax preparation for this last tax year and how to set some good habits for next year. Here's what we're going to talk about today. Thinking about what's special about family childcare taxes, because boy, are we special. We'll talk about some red flags for tax preparation, and if you come across or experiencing these things, how to think about those experiences and potentially adjust them. And then thinking about green flags, how you can set yourself up for success. We'll share a little bit about our organizations and the other support that we offer between Satellite and WICA, and then we'll have time for your questions at the end. If you have questions along the way, you can put them in the chat in English or Spanish, and I can either pause if it is the thing we are talking about right then, or I may save them for the end. If we do not get to all of the questions, I am happy to work with Satellite to put together a Q&A document after this session that they can then send to you with the recording. I don't want people to feel stressed out if we don't get to their question. Let's go. So, in your own words, why do taxes feel so stressful? And please feel free to put your answers in the chat. Or if they're not stressful, why not? Chiqueta says lots of numbers. Jasmine says the IRS. Tracy shares because you might owe money. Tammy says audit, as does Kim. Want to get it right. Being new to childcare, so not sure what to do. Never knowing how much we owe. One of the providers talks about the software that they're using and how helpful it's been. Mary talks about understanding how the numbers all work together on your tax returns to think about when your taxes are due, how much that will be. The IRS is not friendly. It might not be friendly, but you can be super prepared so that you don't have to be scared of them. Justice Phone says you work hard and they still take your money. That is true. Doing taxes, it supports the larger world, but also it feels hard when those payments have to go out. Maria says it's because of how much I owe. Thank you for that translation. And missed deductions. So we'll talk a little bit about all of these things. I don't know if it helps you feel any better about this, but I was a family provider for 6 years. I tried to take my taxes to H&R Block my first year because I didn't know exactly what I was doing. I had read some Tom Copeland books, had prepared and organized, and as I slid my little box of tax paperwork over the desk, they pretty much pushed it back to me and said, "You look like you know what you're doing." And I tried to push it back to them and say, "But I'm trying to give you my money to do my taxes." And they kind of pushed it back to me again and said, "It looks like you know what you're doing," which was actually the start of how I got so interested in family child care tax law and understanding how those forms work and being dedicated to helping other family child care providers understand how they function so that they can make the most informed, educated decisions when they're doing their tax preparation. I have been specializing in business practices and tax education for family childcare for about 20 years, and I actually love it. So while you might not love your taxes, I love understanding how to do them and do them well so that you might have some peace of mind and have some understanding about those tax forms, what they do, how they function. So you can all thank H&R Block for me being here today. All right. My job is to help you feel a little less stressed by the time this is all done and to have some concrete answers and understanding about some of the parts of tax preparation to help impact your business's bottom line. So one of the questions I often get is, how do you vet your tax preparer or to understand if they know what they're doing? Many tax preparers will tell you they can do your taxes, that they understand because they have other clients, right? So that's one thing that people will ask when they're trying to understand if their tax preparer understands taxes. They'll just ask, "Do you have other clients like me?" Here's why that might not be the best question to ask. They can have other family childcare clients, but it doesn't mean they actually understand the family childcare tax code, right? They might be doing all of those clients incorrectly. We have been doing WICA, the Wisconsin Early Childhood Association, has been doing some work with the national partner Civitas to better understand tax returns, especially for family childcare providers. And what we're learning is very eye-opening. We had one provider who prepared 5 years of tax documents with their tax preparer. 4 years were done with one tax preparer. The 5th year was done by a different preparer because the first one retired. All 5 years were done incorrectly. And all 5 years were done incorrectly in a different way. So the tax preparer was not even being consistent in the types of mistakes they were making. For me, that's not acceptable. We want tax preparers and the providers whose taxes they are to understand family child care tax law and those tax codes and the deductions and the ways in which we are allowed to write things off. So here are some questions that I would ask if I were vetting a tax professional. Do you know Tom Copeland? Tom Copeland has a series of business books specifically for family child care. Each year, a tax workbook is also prepared after December 31st, and it's usually released in early the following tax year for the previous year. Tom retired a few years ago, as some of you may know, and I think I miss him every day. What is true is that Civitas has taken over that taking care of business blog that Tom had, and now currently answers those family child care tax questions and provides a whole library of business practice documents available in English and Spanish. In addition, there are videos. In case reading is not your favorite thing to do, you can actually watch the videos in English or Spanish as well. We think it's a great resource. It's very thorough, and it involves more than just tax preparation. It includes things like budgeting, employing your own child, which I think often can be a situation that family childcare providers consider, financial forecasting and looking down the road of how to predict sort of where your finances will be, profit and loss statements, and also other business basics. So especially if you're new and this is your first year, this resource might be really helpful for you to look over after this session. So if a tax preparer says no, I don't know who that is. I have no idea who Tom Copeland is. I don't know anything about his books. That to me is a caution, because I feel like if you are going to be conversant and familiar with family childcare tax realities, understanding the resources that Tom Copeland has created and that Civitas carries on now is a key indicator. If they don't know Tom, it's not 100% that they don't know what they're doing. I just then want to ask more questions. So one of my favorite questions to ask is, how do you write off a load of laundry? Now, you may laugh and think that this is a ridiculous question. But what it does is teases out all the different realities that a family provider might experience in their shared expenses between their home and their business. There is a calculation that providers do called the time-space percentage. And if your tax preparer does not know how to correctly calculate that, you will not benefit from all of the tax deductions in the proper way that you are entitled to. So if I ask my tax preparer, do you know how to write off a load of laundry? If they say, well, you just figure out what it costs at the laundromat to wash a load and to dry a load, and then you just multiply that times the number of loads of laundry you do. That could be true, but only if you are actually taking the laundry to that laundromat, paying that money to the laundromat to do those things. And then I would add, you should also be counting your mileage, because that would be a business trip for you to do that business laundry. But what is really true for more providers is that you're looking at the cost of your water utility. You should be asking me, do I have detergent that is just for the childcare business, or is it shared between your home and the business? They should be asking me about my electricity utility. They should be asking me about depreciation for the machine, right? There are lots of elements that could be written off within that load of laundry. So while it's a simple question on the surface, it's actually a very technical question to carry out. And so I listen very carefully when people talk about how they write off expenses that are shared between the home and business to ensure that they're doing that correctly. And we'll talk a little bit more about how that works. I mentioned time-space percentage. It is one of the most important numbers you can know as a family childcare provider. Your time-space percentage is a calculation between your time, the number of hours you've worked on your business, on your property, and how you use your space in your home. Space can be used as regular use, which means you're using it regularly, usually at least several times a week or on a regular cadence. It can be exclusive use, which means it is only used for your business and not anything else except for potentially walking through it if you need to access a different room, or not used at all. when you are thinking about your time space percentage, it can be beneficial from a tax perspective to use 100% of your space. What is true, in order for that space to be a regular use, it does not mean that children have to access it. So if you have a storage room or something like that where you store your materials, but kids are not allowed in there, if those are all your childcare business materials, toys, extra paper, glue sticks, finger paint, if those are all stored in a closet or a small part of a room, you can actually count that as exclusive use, even if children aren't accessing the space. It also doesn't have to be a space that has a barrier around it. So let's say in your laundry room, half of your laundry room is shared between your home and your business because you're doing your own family's laundry and the childcare business laundry. But on the other half of the room, you have a shelving unit that has all of your little bins and materials stored so that you can easily grab them when you need them. You are allowed to split that room between regular use for your home, right? And then also exclusive use for your business. So that's something to think about as you are looking at how you use your space that your tax professional may not have understood or shared with you. You are also allowed to count the space if you are storing things, say, under a bed. So for some providers, they don't want anything business related in their primary bedrooms, say where they sleep at night. They just want that to be a peaceful place, not related to their business work. You can do that and not claim it, or you can slide some professional books under the bed or on a shelf in your room where you do your professional reading and count that as part of your business use of your space. So thinking about the space does not have to be accessible by children, and it can be space for storage. When you're thinking about how your space is used is really key. If you have a garage, that needs to be counted in your square footage of your home, even if it's detached. If you have an attached deck, that also should be part of that calculation. If you have other structures that are not connected to the house proper, unless there is a permanent foundation under them, you don't have to count them. So you may have a storage building that is a pop together plastic storage unit from a hardware store. That is not considered a permanent building, so you don't need to count that in your space. If you have a basement, if it is habitable, as in people can be down there, you can store things, your furnace is down there, that sort of thing, you can count that space. You should count that space. Attics are not required to be counted unless they are livable space. So my attic at my house currently is blown full of insulation. You would not want to be up there just for fun. You would only go up there if you were checking the roof. I would not have to count that space in my time space percentage. My basement, I store things down there. My furnace is down there. I would want to be able and should count that space in my time space percentage. We're going to talk a little bit more about the time portion of your time space percentage a little bit later, but I just wanted to lay out thinking about how you use your home and how you categorize each of the rooms in your home for this calculation. In addition, you should be counting hallways because you're using those to walk through your home to get to other spaces with the children typically. If you use your own children's bedrooms, but just for nap or something like that, even though you're only using it for that small portion of the day, that still counts within your time space percentage. I see a quick question in there. Can I count the hardware store sheds if they are used for daycare storage? You do not count them as a time space, part of your time space. What you do is write off the cost of that shed that you purchased, and you can write it off at 100% if it is only storing childcare business materials. So let's move on to what's next. Thinking about your taxes, you are responsible for the numbers that your tax preparer or whoever is doing your taxes use for the calculations. So you want to make sure you understand how your tax preparer got to those numbers and the math that they use to get to their final numbers. Sort of what did they use for their inputs and how did they get to their outcome for those calculations? Because at the end of the day, you are signing your tax return as true and accurate. So it is okay to ask your tax preparer questions. It is okay to tell them or ask them to explain how they got to a certain number. It is okay to ask them what went into that calculation as far as the categories of deductions they took. Did they use all of the deductions you gave them, only some of them? Why? Why not? You should have a very open relationship with your tax preparer if you're using somebody else and you're not doing them yourself, that it is a conversation and not just, I hand you some receipts, you hand me a tax return at the end of the day, and you don't feel comfortable with me asking you questions. You want to be in a good relationship with your tax preparer to be able to ask all of the questions you need to ask so that you understand your return. Let's talk about some red flags or some warnings for tax professionals. How they treat the time that you work. For your time space percentage, you can count all of the hours that you are caring for children, and you can count all of the hours you are working on your business when children are not present while you are on your property. So for example, if you are doing your grocery list shopping and you are planning your meals and what you need to buy at the store for your childcare business meals, you can count that time. If you go to the grocery store, you can't count your time at the store. Once you get back to your property and you're unloading groceries, you can start counting that time again. Now let's say it's 2026, Kelly. I'm doing online grocery shopping and delivery. So you're doing all of your shopping, your meal planning at your computer in your home. As long as that is related to your childcare business for the majority of those purchases and that planning, you can count that time according for your business. If you are taking a class and you leave your property, right, you would be counting the mileage, you would be counting the cost of that class, but you can't count the time. If you are taking a class in the evenings when no children are present and it's related to your business, you can count that time. Now, some of you, I'm guessing, are also having children present while you are taking this session right now. You can't double dip or count your time twice, unfortunately. So your main duty right now would be caring for children. And if something would happen where a child woke up, you would need to leave and care for them. So that's your primary count for that time. Attendance sheets can count for your records as long as they are updated and show any closings, any early time where you might be done with your day, right? Because the last kid maybe got picked up 15 minutes earlier than your licensed closing time. But you should not have a tax preparer that says, I'm only giving you the time you worked with your children for your time space percentage. Nor should they put any limit on the hours you work when children are not present while you're on your property. On your end, you need to document those hours. So you document the hours you're with kids using your attendance sheets. And if you use electronic record keeping, that's fine. But then you also want to document the time you are working when children are not present. So you want the date, the length of time, what you did. Personally, when I did family childcare, I had a tri-level house with a walkout basement, and that's where the children were cared for. I kept a little notebook on every level of my home so that if a parent called me after hours, or if I sat down to read something related to my business, I was doing my record keeping after hours. I tracked all of that time because this time space percentage is so important. That time space percentage calculation is the number that you get to write off for all of your expenses that are shared between your home and business. For example, utilities. For example, tools, possibly furniture, depending on where it is in your home and how it's used during the course of the day. It is a huge impact for providers' financial well-being to understand that time space percentage and how it works. So tracking your hours is a really powerful way to improve your tax standing because you can raise that percentage based on accurate time count. So like all things tax related, you want to have that paper trail and make sure your documentation is in place. It does not have to be formal. It does not have to be on a spreadsheet. You just need to be able to total up the full number of hours you worked with children and the full number of hours you worked when children were not present while you were on your property, and you can count that. If you happen to be partnered with somebody and they are also working on behalf of your business, right? If you have a spouse, you can count that time as well. If you have a child that is working on things related to your business, as long as you're documenting those things, you can count that time as well. What you cannot do, though, is count the same hour if you are both doing the work on your business during the same period. So, for example, say my business closed at 6 p.m. From 6 to 7, I'm doing paperwork, but my spouse is doing cleanup and maintenance of the childcare space. We can only count that hour once because the IRS thinks we're on some weird sort of date together, spending our time doing this together. But if I work from 6 to 7 p.m. and my spouse works from 7 to 8 p.m., we then get to count 2 hours towards the time space percentage. So thinking about that while you are having folks help within your business, if they're part of your family, might be something to consider as you're thinking about your time space percentage. Often providers can be good about tracking their own hours, but they may forget that if they have somebody else on their property, in their home, in their family, working on the business as well, that time can be counted. Isn't this exciting? I hope it's exciting. If your tax preparer tells you not to depreciate your home, that would be a red flag for me. They may say that because then if you sell your home, there are taxes that have to be paid. But what is true is if you sell your home, you have to pay those taxes regardless. And whether or not you depreciated the value of your home over time, the IRS doesn't care. They will say, well, you should have, but you didn't. So you don't get that benefit of depreciation, but you still have to pay the taxes. So what depreciation is, for those of you that don't live in the tax world, is basically taking something of large value that lasts for a long time and taking a portion of it as a deduction over time. So for a home, like a business, homeowners, you can write off your home over 39 years. So that means each one of those 39 years when you're in business, if you're in business for all of them, you write off a portion of the value of your home. You get a benefit by writing that off, right? Because then you end up paying less taxes in that capacity. But you will still, at the end of the day, regardless of whether you depreciate it or not, have to pay taxes on your home if you sell under typical situations. So for renters, you get to apply your time space percentage in deduction of rent because you are paying a portion of that living space is being used by your business. So for renters, That's how that works for you all. For homeowners, you have an added layer of thinking about depreciation on top of those things. For renters as well, you can look at your time space percentage for any utilities that are not included in that rent. If you have a parking cost, if you use your car for business, which I'm guessing you may if you go and buy groceries and other things for your business, you can write off your time space percentage of that as well. If you have a separate internet bill, separate water bill, heat bill, anything like that, you would use your time space percentage in calculating the deduction for those things. If your tax preparer tells you to not count cash payments, please run the other way. Cash payments are taxable, period. It doesn't matter if they're from Venmo, PayPal, a check that somebody hands you, or $20 bills. All income related to your business is taxable, unless it is explicitly a grant that is stated to be non-taxable. Now, in Wisconsin, we've received a number of payments to providers that have sometimes been called grants. Unless you are a nonprofit, it is typical that those grants are considered taxable income. So you would want to check with the person who is getting that money to you to determine whether or not it is a taxable for state tax and for federal tax. I think in Wisconsin, during the initial COVID outbreak, there were some payments that were not being taxed at the state level, but were taxable at the federal level. That is unusual. All of the child care counts payment and the child care bridge payments, if you are receiving those, are all considered tax deductible. I'm sorry, taxable, not tax deductible. You have to pay taxes on those. All right. So there's a question about employee. I'm going to come back to that because making sure you are classifying your employees and your 1099 contractors appropriately is a key element for making sure your taxes are in order and you're doing things correctly. So there are several types of deductions that you can take. They may be 100% business. So if you buy something that is only used for your business and the business uses it right up, then that is one category or type of deduction that's allowed. We also have shared expenses. That's where that time space percentage comes in. So if I buy a hammer and I'm using it with the kids for a project, but my son is also using it on the weekends when kids aren't around to do whatever he wants to do with that hammer, then that's a shared expense, right? Because we're both using it. There is also what is called business use. So let's say I have, I'm trying to think of an idea, a sofa in a certain space in a playroom, right? And that sofa is almost always used by the childcare kids. My family doesn't really go in that room. They don't really use it, right? I can actually track, if I want, how many hours that sofa is used for my business and how many hours it's used for my family. And it may be that it's used much more for the business. And I can show what percentage that is. Say it's 80% used by the business and 20% used by my family. I can then write it off at that higher level. But I have to have documentation that shows that I've done that calculation. So for many people, that's more paperwork than what they want to do. But sometimes it might make sense with a computer or other thing to show that you're using it more for your business than you are sharing it with your family. And then finally, there's what's called personal expenses, and those are not allowed to be deductions for your business. When you think about how many things family child care providers purchase in a year to support their business, it's a lot. Often we come with a mindset that says, oh, I'm buying this for my business. My kids are probably going to use it at some point. It's probably a time space percentage shared expense write-off. But what we also have to train our brains to do is, oh, I bought something for my family, but guess what? My business ended up using it. That's still a shared expense, even though you didn't originally intend for it to be used, say, for the business. One of the childcare kids spotted that toy or that thing and said, hey, let's use it and play with it. Or you may have said, oh, I need that hammer or whatever else for this project I'm doing for my business. It becomes a shared expense at that point. So I often will counsel folks to save all of their receipts for the things they're purchasing, because you might not realize when you buy something that your business will end up using it in the course of that year. So that's just something to think about. If someone tries to limit your time space percentage by saying it's too high and they're worried about an audit, you have the right to have the time space percentage documented on your tax returns that is accurate and that you have documentation for. When I was a childcare provider, let me back up. Typical time space percentage for a family provider without exclusive use space in their home is around 30 to 35%. When I did care, my percentage was 55.5%. I had exclusive use and I tracked every single minute I worked because I knew it would get that number up. So that meant in my family, if I bought a roll of toilet paper for the shared bathroom space in my home, even though it was only me and my husband living in that home at the time, I could write off 55.5% of that because it was technically a shared expense. So that's why thinking about documenting for your time space percentage is really important. You want to document how your space is used every year because the room use might change, right? You might have a child that goes away to college and now you're using that room differently. So that's something you want to look at every year for how your space is used. And you want to make sure your time is tracked every year because it's going to be different from year to year. I think especially around during COVID, how many hours folks were working related to that business, right? So there should be, at no time does your tax preparer say, it's too high, we should knock it down. If you have documentation that shows that it should be the calculation it is, you are legally allowed to claim it. Do I have templates? I have some tools that we'll share with you when we send out the recording that you can use to help you think about how to be tracking these different things. So I will work with Grace to make sure we send those resources out with you. Now, more fun. Let's get to green flags. Green flags are things you can do to help your business be stronger going into 2026 if you're not already doing these things. Don't wait, make a date. What I mean by this is set aside time in your schedule every week now for your paperwork and record keeping. As you set that time aside, you think, Kelly told me to do this so that I can make more money this year. Thanks, Kelly. And then sit down and do your paperwork. The time you are doing it, if children are not present, you can record for your time space percentage. The more consistent you are, you'll be less likely to forget things. You'll be less likely to miss receipts. And if you really want, make a date with another provider and make it a paperwork date. You can do it by Zoom. You can actually show up at their house. But by being accountable to someone else, right, we're going to do this together, helps you be more likely to get it done. Doing your paperwork correctly and thoroughly is one of the best things you can do for your tax situation. Back up your data. If you have records in only one place, if something should happen where those records were damaged, that would cause a lot of stress for your tax preparation, right? So think about, I might have paper receipts. Where else am I backing up this information? Whether you're scanning those receipts, whether you're putting it on a digital spreadsheet, whether you're storing it in the cloud, I don't care where, right? You might be making photocopies and storing them somewhere else so that they're separate from where you're keeping your regular receipts. Just make sure you have a backup, because if something happens, we don't want your tax world to sort of crash because those records aren't available to you. And also be consistent. When I was a family provider, I would sit in the parking lot of Target with my receipts, and I would mark every item before I started my car. Was it business? Was it personal? Was it shared? Because I wanted to make sure I didn't forget anything. I purchased my purses with a pocket in them that I designated, that's my receipt pocket. Every receipt goes in that pocket every time, right? And then when I sit down to do my record keeping, I know exactly where to go to get them, right? The way I organize my records are the same every year, right? Because I want it to be consistent and become a habit, so my brain just knows what to do. So thinking about what are the best habits that you want to set up, and then how are you going to do that consistently from week to week? Mary, I see your comment about making sure that you are tracking all of your time when you are looking on your phone for materials for your program, when you might be texting a parent back and forth after hours, right? When you are doing your reading for that one kid that really has you stumped about their behavior and you're looking online to find things to help you be a better teacher for them, all of that time counts. So those are minutes and hours that you can be tracking to support your time space percentage. And then I also see a comment in there about helping your family remember to save receipts, because they are sometimes purchasing things on your behalf or on behalf of the family that are shared expenses. Those are great reminders, Mary. Thank you. Mileage is money. So we talked a lot about the time you spend on your property. When you leave your property for business purposes, every mile you should be thinking about is money, because you can deduct over 70 cents a mile for business trips. Think about how many times you go to the grocery store or the library or anywhere else in your community related to your business. Those miles will add up more quickly than you ever imagined. So thinking about having a log book or an app on your phone that will track your mileage for you to make sure you're making the most of every mile. We talked a little bit about receipts, right? Receipts are your track record for what you spent and are the documentation you need for your deductions. So treat them as if they were money, because at the end of the day, the more you can deduct in your taxes, the less you pay, which means more money in your pocket that you get to keep. That being said, you should always think about your taxes as a part of a bigger picture of your financial health, right? If I'm going to buy a home next year, I may not want to look like I only made $11,000 on paper, right? Because I took every single tax deduction I could, because the bank might look at that and go, well, Kelly, how are you going to pay a mortgage, right? So taxes are one small part. So you also want to think about your tax preparer's job is to get your number of taxes as close to zero as possible. You may need to help think about what the bigger picture of your financial life is to ensure that the way you're doing your taxes aligns with some of your larger goals, if that is in your future, for example. All right. I see a quick question in here. Bank statements aren't the same as receipts because the bank statements only show where you shopped. They didn't show what you bought. So you may want to think about, if I know like there are stores where you can be part of their rewards program, and that gives you access to all the receipts that you've ever purchased while you were a rewards member. That might be one way to have a backup set of receipts. You are also allowed by IRS rule to handwrite receipts. You'd want the where, the what, the when, and the how much. Typically, this is done for things like garage sales, estate sales, Facebook Marketplace, right? You might want to add a picture of the thing you actually purchased, right? And the value. If the person will sign at the estate sale or the yard sale, sometimes they don't want to do that. You don't want the majority of your receipts being handmade. That will be a trigger for folks going, something doesn't necessarily feel right. If you are doing delivery and tipping the person that did your delivery, and it is for your business primarily, you can write off your time space percentage for that. If those materials are exclusively for your business and for nothing else, you can write off 100% of that delivery service and the tip. So you're always thinking about, is this a shared expense? Is it 100% for my business? And that helps be that guideline between how you deduct the thing. If you have memberships to organizations, shopping clubs, that sort of thing, if you are using them for both your family and the business, you can write off your time space percentage of those professional or those dues at those shopping businesses. Meals served are money. Some of you may be on the food program, and that is a great way to have an additional stream of income coming in. You will want to have a line item on your taxes that show that that was a line item of income that you had, but you also get to write off the meals. You get to write off more meals and more snacks than you are allowed to claim through the food program. You can also deduct these meals if you are not on the food program, because the food program is separate than your tax preparation. So for tax purposes, you can write off up to 3 meals and 3 snacks a day. They do not have to meet the nutritional requirements that CACFP or the food program requires. If you're on the food program, obviously you want to be following those recommendations so that you meet the eligibilities for those meals and you will get reimbursed. For tax purposes, you can hand the kid a banana and a Pop-Tart on the way out the door, or just the Pop-Tart, honestly, and that counts as a snack. So somewhere in your record keeping, you want to be documenting those meals and snacks that do not qualify for the food program because either they don't meet the nutritional guidelines or they're over the limit that the food program allows. This is an area that is a big write-off for folks because you get to write off the meal amount at the tier 1 reimbursement level, which is the highest reimbursement level, even if you are not receiving tier 1 reimbursement rates. So that's a big impact because we spend so much money on food. You may also, if you want, do the exact amount of food that you use for your meals to deduct, but then you have to keep your receipts. You have to calculate what percentage of that grocery, of that pound of meat that you used for your family and your business, and split out all of that math. For some folks, it's not worth doing the hassle, and it's easier to just do it through the tier reimbursement. Tom Copeland has a record-keeping book called Record Keeping. It is put out by Red Leaf Press. I do not make any money on that book, but I do believe if you're going to be in business for family childcare, it is an excellent resource to read. And I will make sure that that gets sent out in the resources for the training. And if I'm telling you things that are making you want to cry because your tax person didn't do or did do some of these things, you can always go back and amend up to 3 years. So all hope is not lost. You can take a look at your past returns and go, oh, wait a minute, I didn't do some of these things. And if you have the documentation to back up those considerations, you can amend. So don't worry. Also wanted to make sure that folks were aware of this new resource that came out. This book came out in late 2024 in the English and early 2025 for the Spanish. Full disclosure, I helped write it. It was a joy to write, to put down business practices to support family childcare businesses with my friend Paula Drew, who is also at the Wisconsin Early Childhood Association. Her work comes from a center-based perspective. My work came from the family childcare perspective, so both are present in this book. And then the third author, Amy, is a national consultant on business practices who joined us in writing this book. We have the QR codes available. We also, Grace was nice enough to put the link in the chat. All proceeds for this book go to the Wisconsin Early Childhood Association. So I don't make any money off of this book. The Wisconsin Early Childhood Association sponsored us to write it. And so as a nonprofit, all the proceeds go to them. So I also want to let Grace have a moment to talk about all the amazing things Satellite does for providers.
Thank you, Kelly. We have just a few minutes left. I just want to shout out that Satellite, who is co-sponsoring this event, we are a support group, or not a support group, a support, accreditation, and quality improvement system that serve you as family child care educators throughout the state of Wisconsin. We know how complex your work is, and that is why we offer a combination of benefits that you can see here on this slide. I have a link to our support booklet if you are not participating in Satellite and want to learn more.
And then I'm going to just let you know that WICA, as the state affiliate for the National Association for the Education of Young Children, has a ton of programming for support for providers. We are the only statewide food program sponsor. Well, you may also be on the food program through your local child care resource and referral agency. We have scholarships. We have stipend payments, which means cash in your hand for staying in this field and meeting certain eligibilities. We have pre-licensing support in portions of the state. So if you know someone that wants to open up a childcare program, WICA might be the organization they get to work with. We also have our conference, and we have career development, which are our counselors that help folks try to figure out where they might want to go in their work world and what will support them to get there. So I just want to say thank you for being here. I'm really proud of you for showing up. Tax workshops are not usually people's most exciting thing that they do with their day, but it makes such a huge difference in providers' ability to keep their doors open financially when they understand how the tax law works. So thank you for being here. I have seen questions coming through the chat faster than I've been able to answer them all. Grace has let me know that she has tracked all of them for us, and we're going to save the chat. My plan is then to work with her to create a question and answer document that we will translate English and Spanish and share that out with you. It may be a little bit after the recording comes, or we may hold the recording a bit to be able to complete that document for you. But we just want to make sure that you know we take your questions seriously, and we want to make sure you have the tax education you need to feel super confident about your taxes for this next tax year.
Thank you, Kelly, for coming and sharing all of your experience, all of your knowledge about best business practices and preparing your taxes for family child care programs.
I'm delighted to get to talk about this. And if you have a support group or other family child care gathering that you would like me to come and chat with, I also know there are a ton of other folks on this call that have expertise in business practices, and we're here to support you.